Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. Our subscribers and members of our trading community, we all had a pretty good day today trading the futures as well as having a couple of options trades. And I more or less thought we were done for the day, but then I was flipping through the S&P futures, the ES, the micros specifically, and I was looking at kind of intermediate and lower time frames, and I kind of I dropped it down to about a 5 minute chart. And so this is what we're looking at here. And a couple of regions in this chart actually caught my eye. This region right here and this region right here. So what was interesting about it? Well, if you notice, price came up, consolidated here, and then notice these two very bearish candles dropping out of it. Okay. This region right here is essentially an inverted mirror image of that. Pretty much the same narrative. Price dropped here, consolidated, and then notice price rockets out of there with this series of green candles there. That's a very bullish candle. That one's somewhat bullish. That one's a very bullish candle. But notice this string of candles that race up here. And so what's going on here? This represents an exhaustion of sellers. No one's willing to sell here anymore. They were for about 6 minutes. This is a 3 minute chart here. And then all of a sudden, there was an exhaustion of sellers. So price rockets out of there. And if we think about the contracts that are bought, that are acquired by buyers, we could think of that as the demand for contracts in this region. Similarly, we can think of the contracts that are offered up by sellers. We could think of that as the supply of contracts. Okay, and so right in this area here, supply and demand are in balance. Okay, and then once there's that exhaustion of sellers occurs, what's left in its wake, there is only demand. There is no longer any supply here. And so we think of this and call this a demand zone. And so when price returns to a demand zone, quite often we will see another round of buying. Okay, not everybody or not every institution had the opportunity to buy in here if they were waiting to do that because price just left here suddenly due to that exhaustion of sellers. And so when price gets back to here, this is where we would put on a bullish trade. Okay. And so this would be the entry point right here. And then back here, once we identify where this zone is, this is where we would place our stop. Okay. And so when you create one of these demand zones, there are various criteria: how price enters the region, how the candle structure within it, and then how price exits the area. Okay. And so when price got back here, this is where I was going to put on a bullish trade. Similarly, this is where I would put on a bearish trade. And again, it was the same, pretty much the mirror image here, just turned on its head. And so this was an area where there was an exhaustion of buyers. Okay, price consolidated here, supply and demand were in balance. All of a sudden, there's the exhaustion of buyers, and so what's left in its wake is only supply. That's a supply zone. That's where we short. And again, the same exact story. So here's our entry. Here would be our stop out point. And then you can see I actually outlined the risk profile here. This is the micro contract here. This is 8 full points going from the entry to the stop. 8 full points is 32 ticks. 32 ticks at $1.25 works out to $40 a contract. So if you're trading 5 contracts, obviously your risk would be $200. And then similarly up here, pretty much the same exact size zone, coincidentally. And so that was the basis for this setup that I shared with our subscribers and our community members. So at any rate, that was at 2:50 p.m. Eastern time. So there's about 70 minutes to go in the session, and then of course an hour to go, and then there's an hour, of course, for the extended hours. The extended hours going into the end of the day. So at any rate, we figured, what, it's a 3 minute chart. It would probably react quickly if we got an entry, and if not, then there would just be no trade. So that was the setup. So we can see right here price came back here and actually, bounced off this area. I actually wasn't in front of the screen at the time, but you can see it actually came in roughly at around 3:30, 3:35, somewhere there. And so that's where I got in. Price hit off the front line and then started to bounce up. At that point, what I did was I wanted to look and see, okay, where where might this trade go and what might actually get in its way. And so right here, very clearly, it's pretty obvious here. This is a drop formation, essentially the same as up here. And so I figured, you know what, this would be a logical place to take a profit. Okay, and if we kind of just use the visualizer here and move that up there, you can see that would give us a roughly about a 2-to-1 risk profile here. There was our unit of risk right there, and that's a 2-to-1 trade here. So this was 32 ticks. So that if we got up to there, that would be 64, and so that would be a profit of $80 per contract if we actually made it there. Okay, so once we were in the trade, that was the destination and our goal. So if we flash forward, that's where we got. We ended up getting out of the trade, cashed out. Everyone was happy. We got it. We got down to there. We got up to there, I should say. So that trade was over. If we now flash forward just a couple of like a minute here, we can see price, in fact, did come there, and it actually then bounced down. And so it looks like we actually made a right decision. Um, once the trade actually was over, it did actually creep up to here, and then I think it actually then moved up to a bit above this level. Nothing appreciable, but this was certainly the right decision to get out. So at any rate, I thought I would just share that with you here. Anyway, this is Mitch Firestone with Precision Trading Labs. Thank you for your time, and I'll see you next time. Bye bye.